Hey guys, I'm back for another video. A lot of you have mentioned how much you appreciate these videos, so here goes. There was an article in the Wall Street Journal that I wanted to talk about today, and it was entitled, "Why Are Markets So Volatile?" I mean, they're going up 1,000 points, down 1,000 points, up 2,000, down 2,000. What on earth is going on? Well, they said it's not just the coronavirus. And they were interviewing this guy. He runs a computerized trading company. His name is Michael Pomada. And he said that these companies are doing trading not necessarily on the fundamentals, which is typically what you would think you'd want to look at. The cash flows of the company, the profits, the book values of the company. That's what you would look at, and that's not what they're looking at. So it explains a lot of this volatility. But they had a line in here that I thought was fascinating. And it was in page 4, and it says, "Many of these traders are selling shares and other investments to manage their risks rather than profit from a tumble." So you would think, well, wait a minute, that's what you ought to be investing for, to make a return, and that's not necessarily what they're focused on, which explains, helps explain anyway, a statistic that we give in a workshop that I teach every month on how the market really works. And it goes something like this. There was a company called Dalbar Research out of Boston, and they do this research on investor returns versus stock market returns. And quite frankly, a lot of times when you hear the statistics, you think that's a little bit hard to believe. But when you see what's going on and you hear things like this, it starts to make some sense. And then basically they found over 30 years that the average investor in stock-based mutual funds made a return of about 4% per year versus the market at about 10% per year. Just to put that in numbers for you, that means the average investor, if you took $10,000, turned it into about $33,000 versus the market, it would have grown to $173,000. So investors are giving up a lot of return. Why? Because, well, what happens when markets go down, they get spooked and they sell, and then when they hope that they can get back in before it goes up, or when things look better that they can get back in. Problem is that the volatility, as they said in the article, is not just on the downside, it's also on the upside. So if you miss the upside volatility, you missed a lot, and most of the returns historically on the market, in fact, are in just a couple of days, as I've said in previous videos. So hopefully this helps you understand a little bit about what's going on and that there's an explanation. And when you understand things, it's not quite so scary.